The math on your pay stub says you got a raise this year. Your bank account says you're broke. Both of those statements are completely, objectively true, and that core paradox is currently tearing the illusion of the American middle class apart. Picture a standard Friday afternoon. A worker checks their direct deposit. On paper, it's the largest paycheck they've ever earned. The nominal number is up. But watch what happens over the next 72 hours. Rent clears. The gas tank gets filled. The grocery run takes its chunk. The auto insurance autopay hits. Then one unscripted, mundane life event occurs. A chipped windshield, a child's dental visit, a slightly higher summer electric bill, and every single dollar labeled savings is immediately dragged back into checking to cover the spread. Nothing extravagant happened. There was no reckless weekend in Vegas, no impulse purchase of a luxury watch, no maxing out credit cards on designer clothes. Life simply consumed almost everything. Welcome to the ultimate economic illusion of 2026. For the last 2 years, you've been told by policymakers, government charts, and talking heads on news networks that the worst is over. Inflation has cooled. The charts are sloping down. The economy is showing unprecedented resilience. But if the numbers are so good, why does surviving a standard 30-day month feel like running a marathon in lead boots? Here is the cold, statistical reality behind the curtain. In June of 2026, average hourly earnings for American workers reached $37.64. On a macro spreadsheet, nominal hourly pay was up 3.5% compared to the exact same time last year. That sounds like progress, right? It sounds like you're moving forward. But during that exact same 12-month window, consumer prices also rose by 3.5%. Do the basic arithmetic. Subtract the price hikes from the wage hikes, adjust for the structural shift in purchasing power, and the grand total of real hourly wage growth in America comes out to precisely 0.1%, 0.1%. Real weekly earnings didn't fare much better, creeping up by a microscopic 0.3%. You are running faster and faster on an economic treadmill just to stay standing in the exact same spot. And here is the trap that the headline statistics conveniently ignore. When the government announces that inflation has dropped from 9% down to 3.5%, it does not mean prices are going down. It does not mean things are getting cheaper. It simply means that the rate at which you are being squeezed has slowed down. You are still paying 2026 prices on an accumulation of compounded price shocks that began years ago. But now your 0.1% real raise is supposed to make you feel grateful. This isn't just a minor statistical anomaly. It is a fundamental breakdown of the implicit social contract that built modern America. 91% of adults in recent surveys report that rising prices remain a constant, daily financial concern. They aren't worrying about buying a second home or taking an international vacation. They are worrying about whether the friction between their income and their basic survival costs will snap their household budget in half next month. The most dangerous cost in the American economy today isn't the headline bill you can explicitly see and prepare for. It isn't the flat number printed on your rent lease or your mortgage statement. The most dangerous cost is the invisible margin, the financial breathing room that used to sit comfortably between your income and your survival expenses. That margin has been systematically erased. It has vanished into a web of interconnected, non-negotiable costs, skyrocketing property insurance, predatory health deductibles, inflated grid fees, and interest rate traps. When that breathing room disappears, the buffer between normal life and absolute financial catastrophe becomes razor thin. Millions of hard-working families, earning historically high nominal salaries, are living exactly one unexpected $400 setback away from a tailspin. We are going to look way past the polished press releases and political spin to expose the structural gearwork driving this crisis. We are going to break down how housing, energy, food, transportation, and shadow debt interact inside your actual wallet, and reveal the hidden mechanisms quietly transferring your purchasing power out of your pocket before you even clock in on Monday morning. To understand how the American household budget reached this point of systemic compression, it is necessary to examine the structural decisions, legislative changes, and geographic realities that engineered the current housing and infrastructure bottleneck. The crisis of affordability in 2026 is not an accidental economic anomaly. It is the calculated result of decades of policy shifts, interest rate manipulations, and municipal zoning frameworks that systematically transformed basic shelter from accessible utility into an illiquid financial asset. The roots of the modern housing trap trace back to the aftermath of the 2008 financial collapse. Between 2009 and 2019, institutional underbuilding created a structural deficit of millions of residential units across the United States. When the Federal Reserve slashed the federal funds rate to near zero levels during the 2020 economic shock, mortgage rates dropped to historic lows of 2.65% to 3.00%. This liquidity injection triggered a speculative buying spree, driving home prices upward at an unprecedented velocity. However, the structural reality shifted dramatically when the central bank embarked on an aggressive monetary tightening cycle to curb inflation, raising benchmark rates to a target range of 5.25% to 5.50%. By July of 2026, the average rate on a 30-year fixed mortgage settled around 6.55%. While lower than the peak figures of late 2023, this rate combined with elevated valuations created a severe market paralysis, known as the lock-in effect. Homeowners who secured 3% mortgage rates prior to 2022 face a massive financial penalty if they sell, as replacing their existing loan with a new rate would instantly double their monthly interest obligation. Consequently, inventory of existing homes remained historically restricted for years, forcing buyers into a highly inflated market where the median price of an existing home reached $429,300, and newly constructed homes averaged $429,300. The supply response has created a distinct geographical mismatch. Data indicates that housing inventory expanded to roughly 4.5 months of supply for existing homes, while home builders accumulated nearly 496,000 new units, representing over 10 months of available supply at current sales paces. However, this inventory is disproportionately located in sprawling suburban rings or regions lacking robust local labor markets. The geographic trap lies in the reality that where housing is built, high-paying jobs are scarce, and where jobs are concentrated, municipal zoning laws and local anti-density ordinances prohibit adequate residential construction. Furthermore, purchasing the physical property represents only the initial financial barrier. Once ownership is established, secondary ownership costs begin to compound independently of the mortgage principal. Municipalities across the nation, facing declining commercial property tax bases due to remote work trends, elevated local property assessment values to maintain operational revenues. Concurrently, utility infrastructure costs escalated sharply. By June of 2026, residential electricity rates increased by 4.0% year-over-year, piped natural gas rose by 3.0%, and total energy services climbed 3.9%. These operational overheads convert static home values into dynamic liquid drains on household cash flow. The structural pressure on the housing sector directly feeds into the commercial rental market, where primary residence rents maintained a steady upward trajectory, increasing 2.8% year-over-year in June 2026, following years of double-digit compound increases. Because land values and construction financing remain elevated, property management firms pass higher carrying costs, local taxes, and maintenance fees directly onto tenants. The national home ownership rate remains stagnant around 65.3%, reflecting a structural reality where a growing segment of the population is permanently barred from equity accumulation and locked into escalating rental contracts. Beyond regional zoning and interest rate mechanics, climate risk and capital market shifts initiated a secondary collapse in the insurance industry. Between 2018 and 2022, Property insurance premiums expanded at a rate 8.7% faster than general inflation. By 2026, major national carriers initiated widespread exits from high-risk geographic corridors, citing escalating payouts from severe weather events, inflated replacement materials costs, and soaring global reinsurance rates. In states like Florida, California, and Texas, annual homeowner insurance premiums routinely exceed several $1,000s, directly altering loan-to-income qualification ratios for prospective buyers. Data compiled by the Federal Reserve indicates that approximately 6% of American homeowners currently operate without property insurance, with the vast majority citing outright unaffordability as the single determining factor. Among policyholders who retained coverage, 20% reported reducing their protection limits to lower annual premiums, while 14% struggled directly to meet baseline monthly payments. This operational exposure creates a systemic vulnerability. A single localized weather event can permanently wipe out the equity of an uninsured household or force an underinsured owner into immediate insolvency. The structural intersection of high asset prices, restrictive monetary policy, geographic job housing imbalances, and compounding property-level overhead has fundamentally altered the financial mechanics of American shelter. The mortgage or rental contract, once a predictable and stable proportion of monthly earnings, has expanded into a complex matrix of escalating obligations that claims an ever-increasing share of national income before a household allocates a single dollar toward daily subsistence. The financial friction generated by housing and fixed utilities extends directly into the daily operational mechanics of working households, where transportation, food, healthcare, and credit obligations converge. As fixed shelter costs claim a larger baseline percentage of net income, secondary essential expenditures convert remaining liquidity into debt, creating an analytical dead end for family balance sheets across the country. In the transportation sector, personal vehicle ownership functions as a mandatory prerequisite for employment access in the vast majority of American metropolitan areas. Public transit systems, underfunded and geographically constrained, fail to provide viable options for sprawling suburban and exurban commuting routes. Economic data from June 2026 illustrates a volatile cost environment. While used vehicle prices declined by 1.8% and motor vehicle insurance rates experienced a temporary drop of 4.1%, basic vehicle maintenance and repair costs surged upward by 7.0% year-over-year. Gasoline prices recorded sharp monthly fluctuations, ending 26.7% higher than corresponding historical baselines from prior periods. Federal Reserve financial health surveys reveal that 30% of American adults encountered a major unexpected vehicle repair or replacement expense within the preceding 12 months. For households lacking liquid reserves, this single category represents the leading catalyst for sudden debt accumulation. When a primary vehicle breaks down, the financial penalty extends beyond the repair invoice. An unaddressed mechanical failure directly threatens job stability, leading to lost hourly wages, disciplinary action, or termination. Transportation thus operates as a self-reinforcing financial cycle where workers must maintain vehicles to retain income, yet the maintenance costs drain the very income the vehicle generates. Simultaneously, food expenditures remain a primary point of friction. Official figures for June 2026 indicate an overall food price index increase of 3.0% year-over-year. Food at home rose by 2.7%, led by a 5.3% increase in fruits and vegetables and a 2.6% increase in meat, poultry, fish, and eggs. Food away from home climbed by 3.4%. Although these annual growth percentages appear modest relative to peak pandemic inflation, they operate on top of a permanently elevated price floor. The cumulative cost shift forces low- and middle-income households to alter purchasing habits, substituting fresh produce and protein with cheaper, calorie-dense processed alternatives. United States Department of Agriculture data documents the scale of this structural strain, reporting that 13.7% of American households experienced food insecurity during 2024, with 5.4% entering very low food security, a state where normal eating patterns are disrupted due to a lack of resources. Lower-income demographics allocate a significantly higher percentage of their disposable income toward food necessities. As a result, even minor price adjustments in grocery aisles reduce the capital available for housing, utilities, and emergency reserves, turning nutritional quality into a direct trade-off for short-term financial survival. This economic squeeze is further intensified by the rising costs of healthcare and childcare. In 2025, employer-sponsored health insurance premiums climbed to $9,325 annually for individual coverage and $26,993 for family coverage, a 6% single-year increase. Workers directly contributed an average of $6,850 toward family premiums. However, insurance coverage does not guarantee financial protection at the point of service. The average annual deductible for single coverage stood at $1,886, with 34% of covered workers facing deductibles of $2,000 or higher. Federal Reserve metrics show that 26% of adults skipped necessary medical care, prescription drugs, or follow-up treatments entirely due to out-of-pocket cost barriers. Childcare represents a parallel structural barrier to labor force participation. Annual care costs regularly match or exceed state university tuition, forcing working parents, predominantly women, to weigh the net value of remaining employed against the total cost of professional care. In many instances, the net income remaining after tax, commuting, and childcare costs is near zero, causing parents to reduce working hours, decline promotions, or withdraw from the workforce entirely, severely depressing long-term lifetime earnings and retirement accumulation. To bridge the persistent gap between earnings and essential expenses, households have turned heavily to consumer credit instruments. Federal Reserve Bank of New York data indicates that total credit card balances reached $1.25 trillion by the close of the first quarter of 2026. While seasonal paydowns occurred, overall balances remain near historical highs. Aggregate household debt delinquency rates rose, with 4.8% of total outstanding balances entering some stage of delinquency. Furthermore, the proportion of student loan debt at least 90 days delinquent climbed to 10.3%, up from 9.6% in the prior quarter, signaling severe repayment pressure among younger demographics. Surveys conducted by federal agencies demonstrate that 16% of adults were unable to pay all their monthly bills in full during the preceding month. Concurrently, 16% utilized buy now, pay later short-term installment services to cover routine purchases, with 11% experiencing overdraft fees or payment triggers as a result. Among individuals who reported struggling financially, credit card balances expanded by more than 35% since 2023. Credit, originally engineered as a short-term smoothing mechanism for large capital purchases, has effectively morphed into an emergency lifeline for recurring daily necessities, locking millions of consumers into high-interest debt traps that compound every month.